Joining us now for a closer look at what's playing itself out in the market scene is Patrice Rassou from Ashburton Investments. Patrice, a happy Friday to you. Thank you for your time.
Happy Friday and happy viewing to all the viewers.
It has been quite a volatile week. It's been red screens, and today we're seeing a green screen there. Let's just talk about the week that has been and what markets have had to contend with.
Yeah, I think the big story has been a reversal in leadership. I mean, if we look at global markets, it's been all AI stocks which had led the way from the beginning of the year. Everyone had NVIDIA on their lips, and now we've seen a bit of a change in sentiment towards AI. I think looking at some of the detail of what Alphabet, parent company of Google, talking about that really the investment in AI will take some time to bear fruit. I think investors have decided maybe to take some profits, and we're seeing a rotation from these mega caps, the so-called Magnificent Seven and semiconductors, into smaller caps. So you've had the Russell 2000, which is a broader index of smaller caps in the US, really outperforming and rebounding. So we've seen this mini rotation that has taken place, and a bit more, I would say, of a conservative approach towards the winners of yesterday.
Also interesting, I guess, today we saw the US out with its second quarter GDP. A little stronger, I think, than what we had hoped. It came in at 2.8%, I think, and that's up from 1.4% in the first quarter. I'm wondering what that does for the US story, considering what we've just said about markets there, but also considering the inflation story.
Yeah, it's a very good point. 2.8%, as you say. I think the consensus was 2.1. I think the one thing that the market is getting to grips with is, on the one side, has high interest rate impacted inflation? And we'll see that with the core PCE release, where we're expecting the rise year on year to be at 2.5% versus 2.6% the previous month. But the important part, to go back to the GDP story, the US is not slowing. We're not seeing signs of a recession, which means that we might have a Goldilocks scenario whereby the US economy slows only a little bit, still very high in the 2% mark. Inflation slows, and the Fed starts cutting in interest rates.
Well, I think we are all hoping for those interest rate cuts. Another interesting theme that emerged this week, Mercedes-Benz, I think, out yesterday, letting markets know that they're cutting their margins forecast there. But what it really also feeds into, Patrice, is the luxury story, luxury goods. Tesla also disappointed a little bit. LVMH not doing best. Kering, owner of Gucci, also. Really just speaking about a market that has been resilient, actually, over the last 24 months or so.
Yeah, I think it's a very good point. I think it's a story that the higher interest rates and inflation have really hit the consumers' pockets. In the case of the vehicle market, I think, and you see that in South Africa, it's the affordable brands which are really gained with the consumer. The Chinese brands, for instance, locally with Chery and Haval really making inroads, and we've seen Mercedes-Benz drop in the rankings, and also BMW. And it's an affordability issue. And we see that globally. You say rightly, when you see luxury brands, we've seen LVMH, Burberry's, and seeing softer sales. And really the consumer, which had become, akin to mass luxury, are actually pulling their horns in a little bit, which is not a surprise given the tough economic, high inflation, high interest rate environment.
Another one we saw this week, China doing its best for its own economy there. They cut their one-year benchmark rates. They've doubled subsidies for EVs. It looks like there is a little bit more stimulus coming through. I'm wondering just what your thought is on that issue of stimulus. We were hoping for more stimulus sooner. We're still seeing stimulus come through. Is it maybe some sort of concession that the economy there is weaker than anticipated?
Yeah, I think it's a good point. I think the concern in China is the consumer who was sitting on quite large savings reserves, have become extremely cautious, and they've been hurt by the decline in the property market. You've had residential property sales down 26% year on year, so that's really in free fall. and consumers are sitting on their hands and not wanting to spend. So what the central bank has done in China is they've cut the medium-term lending facility. That's the first reduction on over a year. So cutting interest rates, hoping that demand will be stimulated. But I think it's a difficult one. So it's a question of consumer confidence. It's a question of the Chinese consumer feeling that they want to weather the storm first. And we get into a situation that after the initial rebound, after the lockdowns, the consumer is back to what it was, almost spending as if the economy was in lockdown, which is quite scary.
Then I must also ask you about what we're seeing with Brent. It's at $82 a barrel. We saw it kind of anchored around $85 last week, and maybe in my mind that would have been the fair value at this time. But we're seeing it, shedding off there a little bit. And I'm keen just to get your thoughts here. So, of course, it also is a demand and supply story there, and maybe also an indication of what is happening with China.
Yeah, there's a Chinese story, which is a demand story. There's also I think there's second guessing if you think about the political stance of many. So initially there was the view that, for instance, with the Trump presidency, which would be a lot more pro-fracking, pro-fossil fuels, that maybe supply would come online. So I think there's a link between the economy and the political economy coming into it here, and obviously. The overall umbrella of that is also geopolitics and what's happening in the Middle East, which continues to be quite a dire situation with the war, both there and also the ongoing war between Ukraine and Russia, which has a negative impact on the market.
Well, Patrice, I'd like to go into our stock pick segment now, but I'd first like us to look at counters that have found favor with industry peers.
Going with a little bit more defensive, and it's offshore for a change. I normally choose local, but we're going with Johnson & Johnson, traded on the NYSE. Most of you will know it. It's part of everyone's lives in some shape or form. But defensive, it is a healthcare. Healthcare tends to do reasonably well in a US earnings cycle. Johnson & Johnson trading around about 23, 24 times price to earnings. It's about down 1% or 2% on the year. It needs to play a little bit of catch up, but I think looking pretty good as we take a more defensive stance going into those November elections.
I really like the Tencent business. And then obviously our plays on that on Naspers and Prosus. So the Naspers discounts deeper towards Tencent, and then there's sort of a discount to Prosus, which I think is the right way to play it. I believe in the sort of current management. I think Fabricio Bloisi, the new CEO, is the right person in terms of the remaining sort of run portfolio because of the large exposure to food delivery. And I think there's nothing that stops the ongoing catalyst of switching their Tencent into Naspers at the current price. And I think it's very hard to go against that flow. And with Tencent very depressed, it's all from 400 Hong Kong dollars to 350 now, and there's a big discount. I think you've got an incredibly large amount of protection in Naspers, and then you share all the upside, the potential upside from China, the potential upside from the food delivery, and the potential narrowing of the discount. So I think Naspers makes a lot of sense in the sort of current pricing environment.
My stock pick is Salesforce. It had a good 25% pullback from its highs, as the software stocks pulled back. They are the leading CRM, customer relationship management software in the world. They have about a 22% market share. It's an incredible cash machine, and it's trading the cheapest on a price to free cash flow basis that it's traded at in years. It's down at around 20 times next year's cash flow. And I think they're well positioned to benefit from this continued and accelerated migration of data onto the cloud, and actually utilizing that data to drive business revenue and value creation. So that's my pick of the day. Salesforce, great business, high quality, and a great opportunity in this pullback.
All right, Patrice, keen to get your thoughts on some of those counters. We've got Johnson & Johnson, Naspers, and Salesforce.
Yeah, I think Johnson & Johnson, very defensive counter. We know some of the very well-known consumer brands, especially in baby, also in medical devices, and some of the pharma products, again, very well-known brands. I think it's at this point in time with a lot of volatility, very defensive, not cheap, but I think one which will do well going forward, and also very good performance of previous results. If we move on, Naspers, I think is one which is well known here. With the new CEO and management actions and turnaround in the Tencent performance, I think it's one which is going to do well. Still trades at quite a bit discount to the underlying listed holding, which is Tencent, and I think there is a lot of positive momentum in terms of what they are going to do with their unlisted portfolio. And the last one, just remind me, what was the last?
The last one was Salesforce.
Salesforce, again, is one which is probably going to be in a bit more difficult position. It is in the enterprise software area. There, it's linked to what companies are going to do in terms of their spend, competing with a lot of the different priorities from various companies. I think it will benefit from the AI trend and the whole move to greater access to data. But I feel like this stock is trading quite expensive at this point in time.
With that said, which counter are you loving this afternoon?
Yeah, I mean, locally, I think an interesting story is turnaround will be far. I think management are taking a lot of actions to dispose of the non-core operations, and the South African core business also had some issues which looking to turn around now. I think it's, again, one which is defensive in this current environment. And offshore, I think that AstraZeneca is quite interesting in terms of the pharmaceutical area, especially in their penetration in terms of oncology drugs, chemotherapy. I think there's a stock which is trading at reasonable valuations.
Patrice, thank you so much for wrapping the week up for us here on Business Lunch. An absolute pleasure. That was your midday markets update with Ashburton Investments, Patrice Rassou.